If there is one cardinal rule that years of market engagement have forcefully engraved, it is this. Compensation from the exchange is not granted for sheer participation. It is earned through verifiable accuracy. Frequently, this requirement for correctness mandates the mastery of strategic inaction. This is universally the most challenging feat. Do you grasp the implication? Every novice pursues transactions. Every enthusiast demands movement. Yet the market functions not as a roulette wheel, but as an impartial scale and, critically, a protracted siege. Premature entry yields nothing, nor does delayed reaction. Remuneration is secured exclusively when the defined, optimal setup materializes, matched by the fortitude to patiently endure its arrival. Why does the majority stumble in this profession? Is the failure attributable to their inability to interpret technical data? Scarcely. Many competently recognize patterns and indicators. Is it insufficient capitalization? Rarely. Their demise stems from an inability to defer action. They are slaves to impulse. Like the compulsive card player needing felt beneath his hands, this appetite for immediate stimulation, this craving for continuous engagement, acts as a corrosive agent in speculation. Have you ever detected yourself gazing at the tape, rationalizing perhaps one small position, just to maintain relevance? That very impulse is the instrument that liquidates fortunes. In my formative years, working in the bucket shops observing the tape tick by, I erroneously believed brilliance lay in cleverness, in dissecting and transacting every minute fluctuation. Certainly minor successes occasionally followed, but they were exceptions. Predominantly small victories were offset by small defeats, leaving me at the close of the campaign with nothing but exhausted energy. It was then the fundamental truth struck me. Sustained wealth generation is not the result of perpetual trading. It is the result of stillness. It is the vigil kept until the genuinely significant opportunity manifests. Does this paradox resonate? That maximum profitability accrues not from action, but from disciplined restraint. Nonetheless, it remains an indisputable fact. Be warned, the marketplace specializes in penalizing haste. If you pursue a move, you pay the premium. If you speculate without evidence, you incur the cost. If you compel a transaction, the price is extracted. Conversely, if you remain static, hands firmly metaphorically pocketed, until the prevailing situation is crystalline, you will observe a dramatic improvement in your favorable probabilities. The critical achievement is accepting that daily engagement is unnecessary. Do you genuinely think substantial capital is forged through incessant minor conflicts? Absolutely not. Monumental wealth is derived from pivotal movements. Such movements do not appear hourly, nor are they weekly guarantees. They surface solely when all governing conditions are optimally mature. Until that precise moment, one waits. Understand the nature of setups. They function as a fixed schedule. Should you fail to board one, resist the destructive impulse to chase it down the rail line. A subsequent opportunity will invariably arrive. However, you must meticulously identify which conveyance you anticipate and its exact point of embarkation. The majority of participants operate without codified setups. They latch onto any volatile movement. This is not professional trading. It is reckless speculation. And speculation is a reliable mechanism for self-destruction. You would never enter a major casino presuming to defeat the establishment by contesting every single round, would you? Why apply that self-defeating logic to the capital markets? The most lucrative transactions I've ever executed, the ones responsible for major acquisitions and stability, were never born of happenstance or gut feeling. They emerged from defined frameworks. I maintained faith in established patterns and conditions that rigorously aligned. And until that congruence was achieved, I executed nothing. That is the fundamental truth most refuse to accept. Inaction is mistaken for passivity, but in reality, waiting is the hardest work. Waiting is the manifestation of self-control. Waiting constitutes the legitimate skill of the trader. Can you endure monitoring a chart without initiating a trade? Can you restrain your fingers when the impulsive urge to transact demands immediate relief? That is the litmus test. I formerly felt compelled to exploit every fluctuation, upward, downward, sideways. If there was discernible movement, I had to be included. The result? Excessive commissions, operational errors, and a perpetually wounded ego. Then came the moment of profound self-correction. I grasped that I required only a fraction of the move, the most voluminous high-probability segment. The robust center where the probabilities were evident, the momentum sustained, and the structural setup undeniable. This was revelatory. Do you fully comprehend this differentiation? The market constantly furnishes chances, but they are not equivalent in value. Most are mere static, some are deliberate traps, but a few are pure profit. You must condition yourself to reserve your commitment solely for those golden opportunities. Let us now discuss charts. Charts serve as your navigation system and orientation device. They inform you of the present location and the historical context of the market action. They will not, however, reveal the future through clairvoyance. That is the function of the setup. A setup is simply a precise configuration, a validating signal, or a set of environmental factors that demonstrably enhances the statistical advantage. Whether it is a confirmed breach above a consolidation range, a reliable retest of support, or a surge in transactional volume confirming underlying strength, regardless of the form, you must recognize it intrinsically. Failure to do so results in perceiving opportunities where none exist. Admit this. Have you ever willfully distorted a pattern onto a price chart purely out of a desperate need to initiate a position? That defines the inherent peril of impatience. One begins to construct phantom signals. And here is another severe truth. The market offers zero reward for approximate setups. Proximity does not constitute payoff. The condition is either fully present or definitively absent. When the latter is true, you remain stationary. That single behavior delineates the chasm separating genuine professionals from mere amateurs. The amateur requires a trade. The professional demands the specific, validated trade. Can you distinguish the gravity of that difference? I can provide a tangible example. During one significant campaign, I endured weeks of monitoring a stock as it constructed the required base structure. Daily, it offered minor temptations and fluctuations, but it lacked the requisite readiness. Fellow traders criticized, "You are sacrificing profits, Jesse." I possessed superior knowledge. Then, abruptly, volume expanded dramatically, the key resistance line shattered, and the arrangement became flawless. I allocated heavy capital. That singular transaction generated more profit than a dozen smaller ones combined. Crucially, I would have been unable to seize that opportunity had I depleted my reserves chasing meaningless noise the preceding week. Does this perspective compel you to reconsider your current operational customs? In the discipline of trading, patience functions analogously to liquid capital in a vault. Every engagement you refrain from, every substandard setup you bypass, constitutes conserved financial power. And conserved currency is resource immediately available for the optimal strategic maneuver. The market will incessantly offer distractions, incomplete patterns, maybes, and near misses. You must exhibit resistance. Why? Because your mandate is not to play every available card. Your mandate is to execute only the statistically probable winning hands. Would you sit at a high-stakes poker table and commit your chips to every deal? If so, you would face insolvency within the hour. The skilled poker expert folds far more hands than he contests. The same principle governs trading. Folding is an essential, profit-preserving element of the enterprise. Now a reflection on capital accumulation. Generating trading wealth is not predicated on executing 100 transactions per week. Wealth is established via compound returns, by systematically layering gains over extended periods, by ruthlessly avoiding catastrophic losses that necessitate months of recovery. And what factor precipitates catastrophic losses? Impatience. The impatience to manufacture a trade when market data is inconclusive, the impatience to escalate risk on a deteriorating concept, the impatience to pursue a price movement already exhausted. Tell me honestly, have you ever pursued a stock following a violent breakout, convinced it was just beginning, only to have it immediately reverse and inflict a painful lesson? That is pure impatience. That is the failure of self-control. The preeminent resource available to any market participant is not intellectual capacity, technical analysis proficiency, or a sophisticated system. It is simply patience. Absent patience, every other tool is rendered ineffectual. You may possess the world's most robust methodology, but if you cannot wait for that method's validated trigger, you are doomed. This is the unvarnished reality. Reflect on your losing experiences. Were those losses genuinely the result of market deception, or did they arise because you failed to adhere to your own predefined constraints? Most traders suffer setbacks not due to inadequate knowledge, but because they are temperamentally incapable of strategic non-action. They erroneously equate constant movement with forward progression. In speculative endeavor, the relationship is inverted. The fewer operations you conduct, the higher your efficacy, provided your limited actions are timed perfectly for maximum impact. Is this concept plausible to you? That diminishing your effort results in augmenting your returns? It contradicts almost every principle taught in general commerce. Yet, it defines the essence of market success. Therefore, I reiterate, cultivate the discipline to wait exclusively for validated setups. Sharpen your discerning eye. Memorize your signals. Maintain rigorous restraint until those signals unequivocally present themselves. When they do, and only then, execute with absolute conviction. This is the architecture of trading. This is how sustained success is constructed. And do not misunderstand this directive. Waiting is not synonymous with negligence. Waiting does not permit mental wandering. Waiting signifies intensive preparation. It involves relentless chart scrutiny, monitoring critical thresholds, codifying conditional triggers, and maintaining operational readiness. Because when the decisive setup arrives, hesitation is fatal. You cannot be unprepared. You must be poised to strike decisively. Do you observe the critical balance here? Premature action leads to error. Delayed action leads to error. Acting precisely on time secures the profit. And the only pathway to identifying that crucial moment involves meticulous preparation conducted throughout the waiting phase. The truth is that successful trading requires greater strength of character, temperament than intellectual brilliance. The market routinely humiliates the most astute individuals. But the patient participant, the disciplined operator, he endures. Why? Because he adheres to his selectivity. Similar to a professional baseball hitter who bypasses marginal pitches, he waits exclusively for the ball within his designated power zone. Then he commits fully. That is the mechanism of victory. Are you swinging indiscriminately at every offering, or are you prioritizing your optimal pitch? That is the essential self-assessment required. The market remains wholly indifferent to your personal opinions. It does not factor in your inherent need for constant engagement. It ignores your aspirations for quick wealth. It responds exclusively to setups, structural conditions, and statistical probabilities. You cannot impose your will upon it. You can only harmonize your actions with its prevailing state. And that alignment is achieved by waiting until the market unambiguously reveals its intention. You might assume prolonged waiting is inherently tedious. Allow me to counter. There's nothing remotely tedious about capturing a monumental market shift. There's nothing uninteresting about watching a strategic trade unfold perfectly while the crowd remains bewildered. That sense of accomplishment, that profit realized, is solely attributable to your restraint. Boredom is the implicit tax levied for enduring success. Can you tolerate monotony? Can you navigate quiet trading periods without forcing impulsive action? If you can, you possess a tangible chance in this endeavor. If you cannot, you should seriously pursue an alternative vocation. I made it a point to observe the behavior of the mass of traders. The collective relishes sensation. They embrace the constant chatter, the speculative tips, the flurry of activity. Yet the consensus is nearly always mistaken. The root cause, their chronic impatience. They are unable to maintain stillness. They must perpetually be engaged in transaction. This proclivity ensures their recurrent failure. To achieve success, one must adopt the antithesis of the general methodology. Maintain separation, exercise patience, await your verifiable setups. Logically, if the majority experiences net loss, is it not mandatory to diverge fundamentally from their operational strategy? And commit this to memory. Financial power is generated in the massive shifts, the great directional campaigns. That is the origin of substantial wealth. It is not found in scrambling for small increments or scalping market noise. Significant capital accretion originates from accurately identifying a true directional thrust and riding its duration. But to ride it, you must first wait for its initiation. And the vast majority cannot wait. They demand the emotional rush now, they seek the profit immediately. Consequently, they forfeit the major moves because they were too preoccupied chasing insignificant fluctuations. I demand an answer. Do you prioritize emotional stimulation, or do you prioritize enduring prosperity? Do you value the sensation of being busy, or the reality of being correct? You cannot possess both. Engaging the market for excitement is a guaranteed path to insolvency. Engaging the market based on setups is the only path to victory. Daily, the market presents subtle psychological tests. Here is a slight price change. Do you want it? Here is a deceptive breakout. Will you pursue it? Here is a nearly complete setup. Will you jump the gun? Your discipline faces assessment every single session. Do you yield to these assessments, or do you triumph over them? That result determines your longevity in this profession. The most arduous realization is that profitability does not require incessant activity. Success is not contingent upon innate cleverness. It requires only patience, discipline, and absolute preparedness. The requisite setups will materialize. They are guaranteed. The true dilemma is, will you be present with capital intact and cognitive control maintained when they arrive? Or will you have squandered both your resources and your conviction through impetuous behavior? That is the fundamental daily choice facing every participant. When I stress that the deliberate folding of weak hands preserves financial capacity for validated opportunities, I speak from the hardest, most practical lessons learned. This business bears striking resemblance to a high-stakes card game. The imprudent individual participates in every deal, believing that constant involvement is necessary for victory. The shrewd operator folds far more frequently than he plays, recognizing that the true measure is not the quantity of hands entered, but the quantity of detrimental ones avoided. Do you truly appreciate this distinction? Trading places survival first and net gain second. Survival relies critically on your capacity to safeguard your principal stake. Every dollar committed to a poor probability trade is a dollar unavailable when the legitimate opportunity reveals itself. Contemplate this oversight. Is this not the single most neglected axiom in this entire discipline? Your tactical reserves, your capital, are finite. Exhausting that limited ammunition on marginal configurations is the fastest mechanism to remove yourself from the war before the conflict even commences. The market is wholly indifferent to your personal desire for position. It concerns itself only with probabilities. And probabilities never favor the trader who aggressively attempts to compel action through substandard hands. I have observed individuals trading like reckless gamblers, casting chips into every potential outcome, convinced that ceaseless engagement would somehow manipulate the odds in their favor. But the market is not a casino. You are not contending with chance. You are trading against mass psychology, human impulse, supply and demand mechanics. When the validated setup is absent, when the chart pattern lacks definition, when the statistical advantage is misaligned, you must fold. Can you execute that maneuver? Can you watch price movement and successfully suppress the impulse to chase? For most, this constitutes the ultimate difficulty. Preserving capital extends beyond mere financial retention. It encompasses the safeguarding of your mental acuity, your clarity, and your psychological discipline. Every poor quality trade culminating in a loss erodes your mental resilience. The cost is not merely transactional, it depletes patience. It fosters a desperate need to immediately recover the loss. And desperation is the inevitable resting place for failed traders. How many instances can you recall where you compounded losses attempting to reach the break-even point? That destructive spiral begins with a single weak hand that you were unable to discard. I recollect periods when cash was readily available and the market looked enticing yet imperfect. My earlier self would have initiated the position simply to feel the involvement. 9 times out of 10, that resulted in expense. My refined self learned to retreat. It is strategically superior to hold cash and appear momentarily foolish than to be trapped in a losing scenario and feel compromised. Do you recognize the shift in operational power dynamics? Cash represents capability. A losing trade signifies vulnerability. Each instance you fold, you reinforce your tactical superiority. Each time you force, you dilute it. Most participants despise remaining on the periphery. They adhere to the maxim that capital must be continuously productive. However, in reality, maintaining cash is also a strategic position. Sometimes the most advantageous position available is complete non-involvement. When you relinquish those weak hands, you retain liquidity, and that liquidity serves as ammunition. That capital is what sustains your survival long enough to successfully deploy resources into the robust setups when they emerge. And when those dominant setups arrive, you will appreciate the wisdom of having kept your powder dry. It is impossible and inadvisable to attempt to capture every single price fluctuation. The marketplace is saturated with distracting noise, partial movements, tentative starts, and deceptive false signals. Attempting to pursue all of them will inevitably result in depletion. Folding inferior hands necessitates abandoning the psychological requirement to be perpetually correct. It requires the acceptance that not every visible opportunity is one meant for your execution. Does this wound your ego? It is mandatory that it does. Trading is not an arena for ego display. It is an exercise in rigorous discipline. Let me share a deeper insight. The most impactful trades I ever initiated, those which propelled my capital forward, were only possible because the necessary reserves were available to aggressively commit. And those reserves were available only because I had refrained from wasting them on the numerous low-quality prospects preceding them. The decision to fold weak hands is not about forfeiting an outcome. It is about guaranteeing preparation. How else can you rationally anticipate the building of lasting wealth in this profession? Do you believe prosperity is constructed by constantly chasing after residual fragments? No. Prosperity is achieved by securing the core profit, the meat. And you cannot afford to seize that core profit if you have starved your resources chasing scraps. It is superficially comforting to believe a minimal loss is insignificant, that a minor operational error is inconsequential. However, accumulate these errors sequentially, and you swiftly excavate a financial hole from which recovery is unlikely. Weak hands inflict costs beyond money. They cultivate detrimental habits. Each time you commit to a weak hand, you reinforce impulsivity. Each time you fold it, you reinforce discipline. Which habit do you elect to develop? Which habit is the verifiable architect of enduring riches? Let us state the matter unequivocally. In speculation, the strategic folding of low probability hands is synonymous with securing your financial future. You possess no certainty regarding the arrival of the subsequent major setup. It might occur tomorrow or potentially next month, but when it does arrive, you must possess the means to act. If you have dissipated that resource on inferior transactions, you will be reduced to watching the opportunity dissolve before you. How often have you lamented internally, "If only I possessed the capital now, I would seize this trade"? That is the penalty imposed by weak hands. That is the true cost of impatience. And do not deceive yourself into assuming effortless recovery. The market does not routinely distribute second chances. When the verified setup appears, it does not pause for your account replenishment. It rewards the participant who maintained readiness, and it discards the one who exhausted his means. That is the brutal, undeniable truth. Are you prepared to confront it? Consider the collective behavior. The trading mass perpetually insists on involvement. The crowd cannot fold. They pursue, they hope, they desperately hold. And the crowd consistently experiences loss. If the objective is to differentiate yourself from this outcome, your actions must diverge. You must fold precisely when they are committing. You must sit when they rush forward. You must wait when they scramble for action. This is the mechanism for preserving your capital. This is how you guarantee longevity in this enterprise. Every decision to fold is a conscious declaration. Every fold states, "This is outside my operational zone. This is not my trade." That is genuine power. That is control. The novice perceives folding as a symptom of weakness. The seasoned professional understands it as tactical strength. Which category describes you? I have sustained periods of weeks, even months, without initiating a single transaction. Observers remarked, "Jesse, you are missing the action." I was missing nothing. I was maintaining my vigil for my designated hand. And when it came, I played it big. That's the difference between dabbling and trading. Dabblers exhaust their means by cautiously contesting weak positions. Genuine traders systematically fold weak positions, wait, and launch concentrated attacks only when the probabilistic advantage is overwhelming. Substandard hands temptingly whisper, "Perhaps this time." They appear plausible, almost prepared. But almost generates no returns. Almost setups are the foundational source of brokerage income and trader bankruptcy. Folding weak hands confirms your understanding that proximity is inadequate. The setup is either absolutely correct, or it is incorrect. If the latter is true, your cash remains sequestered. Is this not the simplest possible maxim, yet the most difficult to adhere to psychologically? Capital preservation lacks glamour. It offers no emotional charge. Folding an inferior position does not elevate the heartbeat. But it is the behavioral habit that distinguishes those who persevere from those who are quickly liquidated. Excitement is the domain of the gambler. Lasting wealth belongs to the disciplined trader. And wealth is established upon rigorous self-control, upon endurance, upon folding the detrimental positions so that you possess the capacity to seize the high-impact ones. The enduring appeal of this regulation is its permanence. Market conditions fluctuate, technology evolves, patterns shift. But the core principle of safeguarding capital by rejecting weak hands is eternal. It functioned during my time, and it will remain essential a century hence. Because the conflict is not primarily technical, it is fundamentally rooted in human psychology. Human nature is inherently impatient, rapacious, and anxious. Folding weak hands is the potent countermeasure to all three. It is the one strategic advantage you fully command. Therefore, I pose the question. The next time a chart presents an attractive yet imperfect configuration, what will be your definitive action? Will you fold the prospect or commit capital to it? Will you ensure your resources are preserved or hazard them on a low probability hand? That singular decision, iterated countless times, is the factor that ultimately determines your success or failure in this business. When I assert that strategic preparation during periods of waiting is equal in importance to precise execution during a trade, I intend this in the most literal, practical sense. Individuals mistakenly equate waiting with inertia. They believe being market neutral constitutes unproductive time. But correctly executed waiting is the most demanding form of work. Waiting involves continuous study. It requires refining your analytical edge. It necessitates conditioning your mental state so that, when the moment strikes, you are free from paralyzing hesitation. Do you honestly believe a successful trader merely awakens, clicks an order button, and receives fortune arbitrarily? No. That fortune is painstakingly constructed during the quiet hours spent monitoring, documenting, analyzing, and formulating contingency plans. There were many days in my career when I executed 0 transactions. Not a single one. To external observers, this appeared to be complete inactivity. Internally, however, I was intensely engaged. I was tracking the tape, meticulously annotating my charts, understanding the precise behavior of the stock under both strength and duress. That process is preparation. Consequently, when the opportune moment arrived, when the setup perfectly coalesced, I possessed an intimate understanding of that instrument, knowing its nuances and predictive responses. This facilitated instantaneous action, devoid of second-guessing. Can you appreciate why the waiting phase must be active, never passive? Preparation is the source of conviction. Without it, even the most reliable setup feels uncertain and risky. Consider this. If you neglect work during the interim, failing to monitor levels, ranges, or volume metrics, when the move finally triggers, you will undermine your confidence. You will hesitate. You will question the data. You will enter lightly when the situation demands maximum commitment. And hesitation incurs a financial penalty. But if you have prepared relentlessly, the instant the signal validates, you are ready to execute. Is that not the required advantage? Many participants confuse patience with negligence. They profess, "I shall wait for my setup." Yet they perform no substantive work while waiting. When the setup finally materializes, they are organizationally unprepared. They mishandle the entry price, miscalculate position size, and panic at minimal adverse fluctuation. That is not patience. That is dereliction of duty. Waiting is not a justification for ceasing intellectual engagement. Waiting is the necessary work. Do you discern the fundamental difference? I offer a further illustration. Assume a stock has been consolidating for an extended period. The amateur waits by ignoring the asset, merely hoping to randomly notice a breakout someday. Conversely, the professional studies it daily. He records the contraction of the trading range, the volume profiles, the reliable entry of buying pressure at established support zones. By the time the breakout occurs, the professional is entirely ready. He knows the critical price parameters, the maximum allowable risk, and the exact trigger point. When the moment arrives, he acts without delay. Which individual do you predict achieves superior returns? The one who waited passively through ignorance, or the one who waited actively through preparation? The act of execution is inherently rapid. Execution is the precise moment of order placement, a process requiring mere seconds. However, preparation demands hours, days, occasionally weeks, and it is preparation alone that validates the execution. Without preceding preparation, execution degrades into random conjecture. How often have you entered a position merely because the chart appeared subjectively acceptable, without having completed the necessary analytical work? And how many times did those impulse trades result in losses that defied explanation? That is the specific tariff extracted for failing to prepare adequately during the waiting period. Markets reward comprehensive readiness. They punish operational laxity. Setups tend to emerge suddenly, frequently at unanticipated times. If your preparation is lacking, you will inevitably miss them entirely. Worse still, you will belatedly recognize them, pursuing the move after its principal velocity is spent. Yet, if you have conducted the necessary diligence, monitoring quietly throughout the waiting, you will identify them instantaneously. Is that not the decisive factor separating those who capture the early momentum from those who are forced to chase a runaway price? Moreover, the process extends beyond technical chart analysis. It necessitates the preparation of your psychological framework, your risk management protocol, and your profit expectation benchmarks. Prior to committing to any position, you must possess predetermined exit points for a negative outcome, target zones for profitable liquidation, and a fixed measure of capital allocation for risk assumption. These determinations are not made post-entry. They are codified during the waiting phase. Therefore, when the decisive moment arrives, cognitive processing is minimized, and only immediate execution occurs. Does this operational logic not hold true? Most participants fail spectacularly not due to the scarcity of setups, but because they neglected to prepare for them. They initiate positions absent any pre-established plan, context, or internal clarity. They operate on impulse, and the market administers the inevitable sanction. If they utilize their downtime for preparatory work, they would eliminate half their typical errors. But they do not. They conflate being out of the market with being intellectually dormant. They permit boredom to transition into recklessness. And that tendency is why the vast majority ultimately fail. There is another essential element concerning preparation. It organically cultivates patience. When you are fully immersed in methodical study, annotation, and analysis, you are significantly less susceptible to chasing volatility. You are less inclined to force a trade because you possess an exact mental blueprint of your ideal setup. You know precisely the conditions you are awaiting. Every external factor can be measured against that stringent standard. This greatly facilitates the ability to decline inferior trades. Is that not the true key? Possessing sufficient clarity to reject the poor prospects? Preparation also solidifies discipline. The more intense the intellectual commitment poured into the waiting process, the less willingness there is to waste that investment on arbitrary decisions. If you have dedicated days to preparing for a specific technical formation, you will not dissipate your focus on random transactions. You will honor your established methodology. But if you are unprepared, you treat every minor price ripple as a potential opening. That is the inherent danger of unprepared inactivity. I have witnessed this sequence countless times. A trader endures weeks doing nothing but staring at a screen. Not preparing, simply stagnating. Then a market movement occurs and he plunges in blindly, unready, over-leveraged, lacking a defined strategy. When the market inevitably reverses against him, he experiences panic because the exit plan was never formulated. He loses capital and remains fundamentally bewildered as to why. Contrast this figure with the trader who utilized his dormant time judiciously. When the movement materializes, he knows his precise mandate. Regardless of the immediate outcome, he operates according to his documented strategy. Which individual is likely to sustain long-term viability? Execution captures the recognition, but preparation is where the critical work is fundamentally accomplished. You do not witness profit accumulation during the waiting, yet it is accruing, masked within the discipline you are refining, the avoidable errors you are circumventing, and the strategic clarity you are obtaining. The financial returns manifest later when the execution is instantaneous and impeccable, driven by comprehensive preparatory work. The market conducts continuous testing. It tests your resolve to wait, your commitment to prepare, and your capacity to maintain composure during periods of quiescence. Most traders fail these tests because they regard inactivity as wasted time. But if you regard waiting as designated working time, you pass the examination. And passing that examination is what ensures your continuous participation long enough to achieve substantial gain. Wealth generation results from the rigorous elimination of superfluous trades as much as it does from successful ones. This assertion seems deceptively simple, yet the majority of traders never internalize it. They believe the route to riches is paved by serial participation, stacking one victory upon the next like construction materials. But wealth in this discipline is not merely constructed by the aggregate of your wins. It is constructed equally and arguably more significantly by the losses you successfully bypass. Do you perceive the required paradigm shift? Every transaction you correctly refuse is an affirmative act of wealth creation, provided it represents one of those unnecessary, low-quality configurations designed purely to erode your equity. Reviewing the historical campaigns that delivered prosperity, they were never defined by endless engagement. They were defined by radical selectivity, by uttering no far more frequently than yes, by resolutely resisting the impulsive demand for continuous transaction. You may not yet recognize it, but restraint is the single most valuable and profitable aptitude a speculator can acquire. How many times have you internally rationalized, I merely need to increase my trade volume to amplify my returns? And how often has that methodology resulted in a deficit rather than a surplus? That is the inherent trap. The market does not reward industriousness, it rewards forensic precision. Unnecessary transactions function like a slow structural decay undermining your account. A single minor infraction appears negligible, but over time the entire framework compromises. The insidious deterioration is unnoticed until the point of collapse is reached. This is the consequence of consistently taking trades that fail to satisfy your most stringent criteria. A small protective stop initiated here, a marginal retracement there. Individually, they feel harmless. But aggregate them, and you suddenly discover that the profits generated by your peak performances have been buried beneath an enormous mass of avoidable losses. Is that not the harsh reality? Your failure stemmed not from a lack of winners, but from smothering those winners under a proliferation of low-quality losers. A specific type of financial health is derived from subtractive processes. Subtracting the poor transactions, subtracting the half-developed arrangements, subtracting the boredom-induced impulse plays. By surgically excising these, you create the necessary space for the genuinely meaningful transactions. Wealth is not simply about seizing every potential opportunity. It is about applying rigorous filtration until only the absolute highest grade propositions remain. Does a master jeweler retain every rough stone encountered? No. He sorts, discards, rejects, until only the true gems are left. That is what you must do with your trades. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.